Hello everyone, welcome to It's All About Economics, and I'm Suraj Sharma welcoming you to the new video lecture, and the topic is public finance. We would be particularly focusing on meaning, nature, scope and subject matter of public finance, and this topic belongs to the paper Public Finance and International Trade from Bachelor's of Economics Part 2. For more details, you can email me or you can text me. And what the objectives are in this particular video lecture, uh, you'll get to know what actually the public finance is using some definitions, then the scope of public finance, the functions of a state or the government, the effects of fiscal operations, and the subject matter of public finance. So moving ahead with what public finance is actually, it's a field of economics concerned with how a government or a state raises money, how it is spent, and what is the effect of these activities on economy and society. If you see from these 3 points, how a government or a state raises money is actually relating to the government income or receipts. The second statement, that how it is spent, is actually relating to the government expenditure. And the third statement, what is the effect of these activities on economy and society, is actually relating to the effect of these activities on different aspects of society and economy as a whole. Now, why these activities are actually taking place is to provide the public with desired goods and services, because there are many goods and services which cannot be provided by private sector. That is why the government sector or the state provides these public goods or services. Next, and how to secure financial resources to pay for these services at national, state or local levels, because at every level we can have different governments. Now, defining public finance, according to Professor Dalton, it deals with the income and expenditure of public authorities and with the adjustment of one to the other. So, what public finance is, it is having two parts. One is income and the other one is expenditure. And we'll see how income and expenditure, these two variables, are actually adjusting with each other. This is actually public finance. According to Professor Findlay Shiraz, the study of the principles underlying the spending and raising of funds of the public authorities is actually public finance. So this is not so much different from the definition of Professor Dalton. These two are actually telling about if, those principles are actually public finance, which are actually dealing with the income and expenditure part of public authorities, and the adjustment of these two, or the interrelations of these two. Now, Charles F. Bestable moves ahead and add two things. One is financial administration, and the other one is financial control in the definition of public finance. Charles F. Bestable says that public finance deals with the expenditure and income of public authorities of the state and their mutual relation, as also with the financial administration and control. So, financial administration and financial control is also the part of public finance subject matter. Now, moving ahead to Professor Ursula K. Hicks's definition, here it is very important to note that uh, Professor Hicks talks about the collective satisfaction of wants. What collective satisfaction of wants is actually, it is the satisfaction of the society, and how they are actually getting this satisfaction is from their wants, and these wants are actually the consumption of goods or services which are actually provided by the government or the state, and how this production and distribution will take place of public goods, merit goods and services, is actually by securing the necessary funds to carry on these purposes. So, according to Professor Ursula K. Hicks, the main content of public finance consists not only the interrelationship of income and expenditure of public authorities, but also the examination, appraisal, and the methods by which government bodies provide for these collective satisfaction of wants and secure necessary funds. So I hope this would make clear to you that what public finance is. I'll make a gist of this. That public finance is the study of the role of the government in the economy and society. It is the branch of economics that assesses the government revenue and government expenditure of the public authorities. So this is what public finance is. Now, its scope of public finance, as we have already mentioned, that it deals with the finances of public bodies like national, state, or local. And we can have two parts of public finance. That is, one is receipts or income, and the other one is expenditure. As far as expenditure is concerned, this is done for the production of desired goods and services, and for some necessary items. And how this receipts are actually coming from is from taxes, which are compulsory payments, and from non-taxes tax sources like fees, loans, and sales of goods and services. This is how the revenue is generated, or the receipts come from. Now, public finance studies the manner in which revenue is raised and the expenditure is incurred upon different items, including the principles, problems, and policies related to these matters, is actually the scope of public finance. Why I'm including principles, problems, and policies into the scope of public finance is only because when these activities take place, we should have some predefined principles to receive revenue or to generate income, and for expenditure also we should have some principles. And in these activities we would be definitely having some problems, because we have scarce resources and we have endless wants. So there would be some problem, and for that we would be needing some policies to tackle those problems. Now, it's very important here to mention that in our budgetary proceedings, we have different entries for public revenue and public receipts. It is very important here to mention that receipts from public borrowings, which are called public debt, and from the sales of public assets are generally excluded from public revenue. So whenever we are talking about public revenue, we'll not consider public borrowings, means public debt, and the receipts from sales of public assets. Now, moving ahead with the functions of a state or the government, here we are having two different approaches. The first approach is actually classical one, which is talking about laissez-faire policy, and this laissez-faire policy actually tells you that the government actions should be very limited, and government should minimize its activities in an economy. What are those activities that are very necessary for a government is the national security. The second one is law and order and justice, and the third is primary necessary functions like the provision of public or merit goods. Only these three activities are concerned as far as laissez-faire policy, and for the other things, or for the from the other sectors, government should avoid to enter in those sectors. This is the one approach that talks about minimizing the role of state or the government in economic activities. For example, we can have the writings of Adam Smith, and particularly in 1776, the book was the writing was named as Wealth of Nations. The full name was An Inquiry into the Nature and Causes of Wealth of Nations. And here, Adam Smith clears that the government should focus on laissez-faire policy, and government should refrain it from most of the economic activities, and should minimize its activities only to these three important sectors. It is actually concerned with capitalist economy, where most of the economic activities are in hand of private sector, and government doesn't interfere in those activities. Now, the second approach is all about the state intervention and control of government, and this approach came later when many of the colonies were got freedom from their owners, and the concept of welfare state came very drastically. Now here we see the writings of Robert Owen, J.S. Mill, and J.M. Keynes, particularly J.M. Keynes in 1936, because in 1930 we had a Great Depression, as we already know that in America and most of the Western economies there was problem, and the recession was there. And here J.M. Keynes pointed out that state intervention should be there. State should increase its activities to mm, make a welfare state, and it was based on the idea of socialist economy. Here the modern state functions were increased very dramatically because of some greater social complexities. What does it mean by, as population increases very rapidly, and uh, they're actually there is actually migration from rural to urban areas for the employment purposes, for income generation. Then there is a sort of pressure on existing infrastructure, and for that the state has to increase its activities and invest in social overhead capital in large amount. What social overhead capital is actually, social overhead capital is the basic facilities and services needed for communities and societies. So whenever there are greater social complexities, the role of government increases very rapidly. And this is the second approach, which is actually telling you about the welfare state and the increased role of state or government. Now, the effects of fiscal operations or fiscal policy. What does it mean by fiscal policy? Is only that in economics, fiscal policy is the use of government revenue collection and expenditure to influence a country's economy. So this is actually the operation of uh, government authorities, and it is actually under the ambit of public finance. Now, what actually the effect of these operations are? These operations or the fiscal policy may affect economic growth by controlling consumption and investment. Then it can have a very important effect on full employment. It can have effect on equitable distribution of income and wealth, then on general price level, and on aggregate demand. How these fiscal operations are actually taking place is using this fiscal policy, and this fiscal policy may have different role in developed and developing or underdeveloped economies. In developed economies there is a problem of lack of demand, and as we have already mentioned that in 1930s many of the western economies were in recession, and that was because of lack of demand. And here the role of government increases very rapidly, and with the help of increased government expenditure, government can increase this aggregate demand. And by increasing the aggregate demand, the growth process can take place. On the other hand, developing and underdeveloped economies have different prospects of fiscal policy. They have different aims. Particularly, they have a target of increasing their income levels, and for that they need economic growth, and while controlling for inflation. So we need economic growth but with stability. It means there should not be fluctuations in general price level so frequent. So by this fiscal policy we can target the employment opportunities. We can actually reach to full employment level. We can have we can have effect on equitable distribution of income and wealth by revenue generation. We actually impose taxes, that is compulsory payment to the government, and we can use this fund to actually for making a welfare state. And this is how we actually make this distribution of income and wealth equitable. The fourth one is controlling general price level and aggregate demand. Whenever we will find that the economy is in inflation mode, then we control general price level by increasing taxes and reducing the amount of government expenditure. And if we feel that there is a lack of demand, we do vice versa. What we do, we actually increase government expenditure. And reduce the tax rates. This is how these fiscal operations takes place, and this is how fiscal policy is used. Now, you would be getting that what are those instruments. The first instrument is public expenditure. By increasing and decreasing public expenditure, we can control general price level and aggregate demand, and by controlling these two, we can control the consumption and investment, and thereby the economic growth. Uh, on the other hand, we have instruments like taxation, public debt, and budgetary provisions. Using taxation, we can control aggregate demand and general price level. Using public debt, we can raise funds for this public expenditure, and with the budgetary provisions, we can make balance between these two. So this is how fiscal operations are done, and this is the effect of fiscal operations on these 4 points. Means first is economic growth, the second one is full employment, the third one is the distribution of income and wealth, and the fourth one is on general price level and aggregate demand. Now moving ahead to the subject matter of public finance. So in modern times, public finance is not only related to income and expenditure of the state authorities, but also it includes financial administration, auditing, control of the same. At the same time, it is the science which study the effect of these actions of a state on society and economy. So this is very broad in terms of public finance, and subject matter also increases very rapidly with this broad area. Particularly, we would be focusing on some terms here, like the first one is public revenue. The income of the government or the state through all sources is called public income or public revenue. Uh, you should be very you should be focusing on just these two, that public income or receipts may differ from public revenue, as I've already mentioned that in public revenue we do not include public debt and the receipts from the sales of public assets. Here the point is the public revenue can be of two types, from taxes, that is the compulsory contributions by the citizens to the government, and the non-tax one that includes fees, fines, penalties and levies, profits of public enterprises, and gifts and grants. Now, the second term is public expenditure. And what public expenditure is? The expenses incurred by the public authorities like central, state, and local governments. And this is called public expenditure. It may be classified as development or non-development expenditure, planned and non-planned expenditure, and revenue or capital expenditure. We would get to know that what is the basic difference between these different types of expenditure in our later lecture videos, and here we would be particularly focusing on only the subject matter. Now continuing with the same, the third and the most important term here is public debt in the subject matter of public finance. And what public debt is, it is sometimes also referred to the government debt, which represents the total outstanding debt in the form of bonds and other securities of a country's central government. The next one is financial administration. This includes preparation, passing, and implementation of government budget and various government policies, because it actually made adjustment between the public revenue or the income or the receipts and the public expenditure. So that is why the financial administration becomes very important part of, and the subject matter of public finance. In last but not least, in modern times, a fiscal policy is adopted to maintain economic growth, and economic stabilization are also included in the subject matter of public finance. And as I have already mentioned to you, that one of the most important target of public or fiscal policy is to maintain economic growth with stabilization. So this all comes in the ambit of public finance. And in some next lecture videos, we will be focusing on particular uh, terms like public revenue, public expenditure, some theories, principles of public debt, and this financial administration means the budgetary process of government. Thank you so much for being with me.